Okay, let's get started. Alex is the regional economist for the Federal Reserve Bank of Richmond. He's based here in Baltimore. He monitors national and regional economic conditions in Maryland, West Virginia, and DC. And he informs the public about the state of our economy. He also leads the Richmond Fed broadband infrastructure and digital inclusion research. And his expertise in the rural economic development out there in Western Maryland and probably all of West Virginia. And he has appeared in the New York Times, the Baltimore Business Journal, and other media outlets. When are you going to get in the Wall Street Journal, Alex?
Totally up to them.
Okay. I'll vouch for you.
Great, I need it. I need it.
We consider Alex to be a friend of the FEI. This is the third or fourth time you presented, is it, Alex?
I think so, yeah.
And we have him as a recurring guest, and we'll have him again for the fall. So if he's amenable, don't ask too many mean questions. So we have an exciting lineup. In October, we have the Pratt Library geared up for an in-person meeting. Be our first one, provided that the Delta variant doesn't close everything down. And I'm not hopeful about that one because it seems to be getting more aggressive. And I want to remind you that there will be polling questions today, a series of 5, and you need to answer them to get CPE credits. So with that all being said, I'm going to turn to Alex.
Thanks so much, Joe. Thanks for having me back. Let's just start by saying that, these are my views and not those of necessarily of the Richmond Fed or the Federal Reserve System. That way I don't have to spend the whole presentation worrying about what's going to happen next. Let me try and advance. Let's start with the poll question. Very curious about people's work status in terms of totally remote, going in person, or some sort of hybrid model. One thing we're watching is what's this going to do with commercial real estate markets for businesses that are deciding to go either partially or fully remote. Okay, that's very interesting. Let's see, I think, Denise, if I just click out of that, I can keep going. Let's see. So this is what I thought we could do is talk about how the economy is doing overall, but spend a little bit more time than we traditionally do on inflation and prices overall, just because that's been in the news so much, and it's it's a real concern. Certainly from the Federal Reserve's perspective, our mandate from Congress is centered around 2 things. One is stable prices, and that's where inflation factors in. And the other is maximum employment. So trying to make sure that when we're helping to support an economic recovery, we keep in mind that we need to do that so that people can get back into the labor market. And so that's both of those are clearly at play. I think given the pace of the reopening and some of the other factors that we'll get to, have really highlighted though the inflation side, and so everybody's rightly taking a close look at that. I had been scheduled to give this a few weeks ago, and what's changed since then is that we have revised GDP figures, which really show that in terms of GDP, we're back on track. We've made a full recovery to where we were prior to the recession. So overall economic activity as measured by that is quite strong on the heels of the COVID-19 pandemic. And I think you can, put that at the vaccination, the rollout of the vaccine and people getting vaccinated and starting to begin to go to things in person and businesses being reopened. And we've also had, as Joe alluded to, quite a strong fiscal policy response as well as monetary policy response on the Fed's part, to help kind of put a floor underneath the drop off that we saw during the pandemic. So I think those factors have really contributed to us being in a strong position coming out. Now, that being said, the sectors that were most heavily affected by the pandemic haven't fully recovered. So that's mainly concentrated in leisure and hospitality. But and that will take some time to fully recover. But overall, across all sectors, we're seeing significant improvement and in many cases full recovery to where we were prior to the pandemic. If you look at the labor market side, though, and just remember from your Econ 101 that the labor market is always slower to recover than the rest of the economy. That just hiring people and finding good fits, and there's a number of factors that go into slower recovery on the labor market side. So that's true in this case as well, like we've seen in every previous recovery period. We're far from pre-pandemic employment, and we're also pretty far off where we were in terms of labor force participation. So that's just looking at the people in the economy who are either actively working or actively looking for work. At the same time, you look at what's happening on the demand side for labor. Job openings are at record levels. And certainly all the businesses or almost all the businesses that we're talking to throughout our district are reporting that they would like to hire and they're having a real tough time finding people. So that's on the labor market side. If you turn to inflation, we have this 2% target, which we'll talk a little bit about, to benchmark how we're doing on inflation. And we have been for the past few months above that target. And it reflects high demand coming out of the pandemic, some supply chain frictions. And also, this is no longer the case most recently, but we were in a period of moving past low inflation readings that we saw from last year. So the way that we measure the target is year over year. So the comparison to last year kind of made the readings more elevated, but there were also real factors at work behind inflation being above target. So we'll get into some of that as well. On the risk side, Joe touched on this. It's the Delta variant. We're already starting to see some closures, and I think it remains to be seen how this will impact everything. I wish I had a crystal ball and could predict it, but I think for sure that is the remaining risk. But overall, I think we're in a very good position relative, certainly to where we were last year, for sure. This is the GDP picture. In Q2, as I was mentioning, we really saw us move from economic recovery to expansion. So we recovered where we were back to where we were in terms of overall GDP, and we're moving to this expansionary period. Forecasts are looking like annual GDP growth for 2021 is going to be, I believe, around 2.2 or 2.1%, which really exceeds expectations. And I think you can, as I mentioned, put that at the feet of the vaccine and the fiscal and monetary policy responses. This has been the deepest recession we've ever had, but also the shortest. And I think that also reflects the fact that this was a public health caused recession, and overall we were in a good position going into it. So the recovery, I think, has been quite quick for that reason as well. What's been underneath that? You know, a figure I always like to mention in my presentations, just to, you know, help orient folks. When you look at that GDP figure, you know, about 2/3 of what's underlying that is domestic consumption. So what people in the United States are spending on goods and services. And so that's why, you know, getting this picture of what's going on with income and spending patterns is really important. And so this is a picture that shows you just that. It's 12-month percentage change of both personal incomes. This is income that's coming in into people's you know, checking accounts and all the like, and how much they're spending. Now you can see on the income side, those spikes on the red dotted line, that reflects the fiscal payments that came out of the federal government that really boosted the amount of income that people had. Spending line is sort of interesting because if you look at the most, you know, recent readings of that, they're quite high. So this is, again, reflects the fact that people are coming back out and starting to spend again. But you also saw that real decline starting with the pandemic. So people, you know, while the pandemic was going on, in addition to getting additional fiscal payments, income overall was going up. People were also holding back from spending, and predominantly saw that right in services, you know, spending on restaurants, vacations, and the like. So what that all translates to is a significant amount of savings. So you can think of the difference between those lines as reflecting savings. And there's somewhere north of $2 trillion saved during this recession. And people have been starting to spend that, and I think that's you know, a big factor behind why we're in the relatively good place that we are now overall. To the labor market side, you know, I mentioned some difficulties there, but if you know, just focused on what, you know, probably the top line indicator that we look at, it's the unemployment rate. Again, this isn't reflecting people who've totally dropped out of the labor force. This is a measure of people who were actively looking over the last 4 weeks for work and haven't been able to find a job. So with that caveat, the unemployment rate's been trending down. Our latest reading for that is 5.9%. And those bars, take a look at members of the Federal Open Market Committee. So that's people in DC, Jay Powell and others at the Federal Reserve System, and then through the other makeup of that is presidents of the regional Fed banks. It basically gives you a sense of where they're seeing the unemployment rate go, and that red dot is the median readings for that. And so predictions are at this point a continued reduction in the unemployment rate, down to about where we were pre-pandemic, starting in, you know, middle to late part of 2023 and then into 2024. That being said, right, it's
Alex?
Yes, sir.
Does the Fed have any opinion on whether the expanded unemployment benefits are affecting unemployment?
Yeah, I'll get to that, Joe, when we get to labor force participation, because that's one of the key factors behind it. I just wanted to touch, though, overall on what the jobs picture looks like in terms of people employed. And this chart, I think, is helpful because it gives you a sense of total employment rather than these year-over-year changes, which can be somewhat hard to interpret given how the last year and a half has gone. But you can see the latest reading we have for that is in June, 145.8 million jobs. So that's about, just for reference, it's about 7 million jobs short of where we were pre-pandemic. And if you had continued that trend line I don't know if you'd see my mouse or not, but just imagine the trend line coming off of that job growth or employment growth over the last decade or so. We're about 9 million short over where we would have been had there not been a pandemic. So pretty far off of where we need to be. And that's also reflected in the labor force participation rates. This just gives you a sense out of everybody, what's the participation in the labor market, what's their people who are employed and or actively looking for work as a share of the population. And the latest reading for that is about 61.6% in June. As Joe was mentioning, there's a collection of factors behind this decline in labor force participation. Not surprising, right, to see the big dip down during the pandemic as businesses shut down. We did see an uptick with gradual reopenings, but we've been at this plateau period of bouncing around a little bit around 61%. And the remaining, what's it going to take to get us back to where we were? It's a combination of factors of school and childcare issues being worked out. I think it's also going to take the sunsetting of these supplemental unemployment insurance benefits. To be quite frank with you, there are all these factors at play. We will not have a good sense of how important all those factors are until schools and childcare get reopened as fully as possible, hopefully in the fall. There's been a lot of debate around how much the unemployment insurance benefits have been contributing. My guess is that it depends on the type of job and the type of worker, but in the data, it's very hard to separate all that out. When you talk to individual businesses, especially those that have lower wage service sector workers, their assessment is that the supplemental unemployment insurance benefits have played a big role. If you look at the states that have ended those, however, you don't see necessarily a huge return to work. And so it's just very difficult to sort out how much all these different factors plays a role. So I mentioned schools, childcare, and supplemental unemployment insurance benefits. There's also early retirees. There are a number of people who, in their late 50s, pandemic comes, they'd been planning to work for another 10 years. Pandemic comes, they, just decide to retire early and not deal with the public health issues or, the risk of getting COVID. And probably our best guess is that those people will not be returning to the labor market once things are fully reopened and we're back to normal. So again, just very difficult to sort out how much all those factors play a role. We'll get a big boost of information once we get to September and schools reopen. And then we'll just have to reassess where we are with this labor force participation. A key point, though, I think to make is that it's not for lack of jobs. This picture, this is fairly high frequency data that we get from a survey called JOLTS, which measures job openings, hires, and quits. That jump in the quits rate you see in the purple dotted line. I've been following those news stories as well. There's been a lot of stories about people, quitting their jobs. In response to whatever experiences they've had during the pandemic, deciding, they want to do something different. But in terms of this job openings rate, you can see that line there at about 6%. This is the highest reading we've had, for decades. So there's a huge amount of jobs that are open right now. I think reflecting how well the rest of the economy is doing aside from the labor market, there's high demand. And there's high demand for workers, but the real problem is getting those workers back to actually working. A key point here to make about this, though, is that you've got to also think about matches. And so not every job opening is going to necessarily going to have one of those people who's out of the labor market or unemployed, who's got the right skills for the job. And so that's a longer term issue we've got to be keeping an eye on in this economy is, how nimble are our workers to be able to move towards the jobs that are available. In this case, it's a pretty big problem coming out of the pandemic because we had a lot of people who were, waiters or working in housekeeping in hotels. But a lot of the job openings, are in manufacturing. So there's this huge mismatch between the people who are available to work and the jobs that are open. But there are jobs there, and we'll be going through this sorting period, hopefully to get this to a better picture. Got a question I saw: is the high demand for workers for low-paying, mid-paying, or high-paying jobs? It's been concentrated, I believe, in the low and mid-paying jobs, which are, these are the jobs that had to shut down during the pandemic, and are now reopening as people get back to going to movie theaters and restaurants and everything. So there's certainly that part, but we are seeing overall strength across the board in the labor market. But I think this high job openings rate reading is probably most likely due to those jobs that were closed off during the pandemic. Okay. Here's poll number 2. Are you concerned about inflation? And just a quick reminder, inflation reflects rising prices overall in the economy. So it's not just for individual goods and services, it's what are prices overall in the economy? How fast are they growing? Okay, got it, Denise, thanks. Okay. Whoops. All right. Okay. So what's the Fed been doing? The short answer is being pretty aggressive at keeping rates low, between 0 and 0.25%. And that's mainly because you've got this economy that's in recovery mode, but the labor market is still lagging behind. And so the Fed's response to this point has been to be pretty aggressive on helping the economy be in a recovery stance. So with that, I wanted to start talking about inflation. And because as the Fed's looking at it, it's not only the labor market side and wanting to make sure that that our labor market is on the full recovery path. But there's also concern about inflation and wanting to make sure that that is kept over time within the 2% range. So just kind of a brief refresher. As I mentioned, inflation is a measure of the growth in overall prices in the economy, and it really reflects a reduction in the purchasing power of money overall. So price stability, which, as I mentioned in the beginning, is one of the Fed's goals mandated by Congress. Price stability occurs when volatility and inflation is minimized. So that's why we have a target for the inflation rate. The Fed's actions, as I showed you on the previous slide, interest rates, it's related to inflation. So one way to think about it is that interest rates compensate lenders for any reduction in the purchasing power of money that inflation creates. And so in this way, there is this relationship between interest rates and inflation, and it's, for that reason, worth keeping an eye on. We typically measure it using the Consumer Price Index, the CPI, although there are all kinds of price indices that are used. The Consumer Price Index comes from the Bureau of Labor Statistics, and it's meant to really capture what prices are doing overall for a basket of goods and services that households purchase. So it uses data that comes from an expenditure survey of households, and it's called this basket of goods. It contains food and beverage prices, rental prices, apparel, transportation, medical care, education, and the like. The Fed, when it's looking at its target, strips out food and fuel prices, not because they're not an important factor in how households are doing, but just because they're highly volatile markets. And when you look at historically price spikes in food and fuel, the energy markets typically are corrected pretty quickly in the market. These are fairly transparent markets with lots of buyers and sellers. And so, big swings in prices are typically worked out fairly quickly. So core CPI, when you hear the Fed's targeting inflation at 2%, it's that core CPI measure. In 2012, the Fed announced let's use a bunch of words that are hard to understand. Symmetric medium-term inflation target of 2%. Some of this is in the eye of the beholder, but I think the key thing to take away is that the Fed's always watching inflation, but inflation can be above or below target for a certain period of time. The key is to get it on average within the 2% range, and that'll be important for as we look at some of these inflation charts, thinking about how the Fed is looking at it and what they might do to raise rates in the future. There's additional guidance, which I think I talked about at our last session in August 2020, that really highlighted the flexibility that the Fed has in responding to recessions with respect to achieving the target. And I think the way to think about it is really just that, reiterating that this is an average. This is not that inflation hits 2% and all of a sudden the Fed's going to raise rates, but there's this trade-off between keeping rates low for too long and risking high inflation versus prematurely increasing interest rates and cutting short a full recovery, particularly as it impacts people within the labor market. So, we've got this trade-off to consider, looking at both what's happening with prices and what's happening in the labor market. So why do we have this target? It helps create some predictability and price stability, as I mentioned. And if inflation's too low, it's really linked with low consumer and business confidence. In fact, if you have deflation, you get a number of problems that arise, and it basically leads to a situation of people holding back from spending, and so it can be a real problem in terms of getting some decent economic growth. If it's too high, of course, people worry about hyperinflation. It reduces price predictability, and it just makes consumption and investment decisions harder. So it can escalate into hyperinflation as people hoard goods and offload currency. So it's a concern there. So that's why we have this 2% target that we're aiming for. I'm going to show you a few views of how prices are doing overall in the market based on the different types of measures that we look at. Again, the target's around consumer price indexes, but we also track what's happening with producer prices as well. And so this is a measure of producer prices. And as you can see, they're quite high. So for June, it's at 7.1%. If you take that core, stripping out food and energy, it's lower, but at 5.6%. But overall, this shows a real high increase in producer prices that we're seeing in the economy overall. I think this really reflects pent-up demand that's outstripped capacity in many sectors. A number of businesses, particularly in manufacturing, pared back their capacity to produce during the pandemic, and it just takes a while to get those factories back up and running and get those workers rehired. And so that's part of what's playing into this here. There's also been bottlenecks that we've seen. You've heard about the computer chip shortage that's affected cars, as well as other computers and all other sorts of those types of goods. There's been logistical challenges and with high demand, being able to get the number of freight containers you need. So there've been a lot of supply bottlenecks that we're seeing overall in the economy that have all contributed to this. At the same time, you're seeing industrial production ramping up in response to high demand. This breaks out into overall, which is the dark blue line, and then the dotted red line is in mining, and the dotted purple is in manufacturing. But you can just see this with this index where we've seen this huge production response to the high demand we've seen coming out of the pandemic, and it really has ramped up significantly compared to where we were during the pandemic. So businesses, are increasing production in response to this demand as quickly as they are, but they're still experiencing bottlenecks, as I mentioned. We're seeing this also within the 5th district. So I know nobody knows what the Federal Reserve districts are, but that's basically the Carolinas, Maryland, West Virginia, DC. We survey businesses to get our own sense of what's happening regionally. And I picked out some of these measures from our survey to show you what's been going on. This first slide's manufacturing, and the next slide will be on the service sector side. What are we looking at? This is a diffusion. These are all diffusion indices, which means if you're above 0, that straight horizontal dark black line, then this is where we're seeing high levels of activity. So I picked out the shipments, vendor lead time, and new orders. Let's take a look at, I was mentioning those supply constraints. You can see that here for our regional businesses with vendor lead time. So this is showing, that's that orange line, showing a pretty significant increase in the time it's taking for manufacturers to get the raw materials they need to produce whatever they're going to produce. So we're seeing this regionally as well. At the same time, you look at what's happening with shipments and new orders. Yes, increase, during this recovery period, but it's nowhere near the increase that these manufacturers are seeing in vendor lead time. So production ramping up, yes, but still seeing bottlenecks as well. The survey changes a little bit when you look at what's happening on the service sector side, just in terms of the things that we measure. But I thought I'd pick out employment, demand, and capital expenditures to give you a sense of regionally what service sector businesses are facing. And you can see demand in that dark blue line significantly increasing, so high demand. At the same time, much like in manufacturing, firms are, increasing employment and capital expenditures in response, but it's really nowhere near the increase to meet the demand. So we're at a point where demand is really outstripping supply. This next polling question, wake up. Is your business cutting back on business travel moving forward? I think this really will play into how leisure and hospitality is doing.
All set, Alex.
Alrighty, thanks. So that was on the business side. Let's talk about what's been happening on consumer side, and I've touched on this already. That this is just a measure of the savings rate, which always goes up, right, when you've got those federal fiscal payments that people have received. So the savings rate's gone way up. If you look at the total, as I mentioned, it's north of 2 trillion, significant amount of money saved up, ready to be spent, and you're seeing that increase spending in retail sales. And I think because this chart's the year over year, so I think the thing to focus on is that little table down there, which just shows you that saw a big increase in April, a little bit of reduction or a fairly large reduction in May. But overall, spending on retail sales has been really quite good. And so you put all these factors together, what does that do to inflation? This is the core CPI measure I mentioned before, dotted lines at the 2% target. And you can see our latest reading for it is at 3.5%. Let's talk about, first of all, though, what's underneath these price increases. If you look at the types of goods where we've seen these price increases, let me see if I can get this right. If you look at vehicles and vacations as a share overall, how much do they contribute overall to that basket of goods and services I was mentioning? They contribute about 8% of spending in that basket of goods for the CPI I was measuring. But if you look at this June increase, prices in those categories contributed about 40% of the increase there. So you're looking at things like prices for hotels, airfares, and rental cars. Those three things alone contributed 25% to this 3.5% increase in prices overall in June. So to my mind, you look at this and you think about, we've been through the shutdown. Now we're reopening. And you look at the types of bottlenecks we've seen on the supply side. So computer chip shortage, cars. Okay, so we're seeing price increases there. And the others are related in a significant way to restaurants and travel reopening. And so this is why, if you look at the Fed Open Market Committee, their latest statement, they still think that these price increases are transitory, that these supply chain bottlenecks will work out. People, are in this period of pent-up demand, spending all the money that they saved, that these things are eventually going to work out. People will at some point have taken as many vacations as they can within this year, and that things will settle back to normal. And I have to say, that's my view too at this point. If we were seeing this, above target inflation reading coming in many more sectors, I would start to get worried. But at this point, to my mind, it's concentrated in these things that you would really expect to see high demand for coming out of a period of shutdown. So that's just how I interpret this overall core CPI reading at 3.5%. The other thing to keep in mind in terms of how the Fed is viewing things, as I was mentioning before, the inflation target at 2% is an average target. And so that means that there will be periods when inflation is below target and periods when inflation is above target. And you can see we were really at a significant period of low inflation, below target, coming out of the Great Recession from 2008 to 2009. So there is, I think, room to run here. But again, it's highly dependent on where we're seeing price increases, the various categories of goods, and how the labor market is doing overall. These bars give you, again, a sense of where participants on the Fed Open Market Committee who are making decisions about, where the interest rate is, gives you a sense of where they see this inflation figure going. To this point, there's expecting it to be elevated, but to move back down towards target by 2022. And so that just gives you a sense of where their most recent projections are. But again, it's not surprising, given this high demand situation that we're in, the supply bottlenecks, the labor market not, a lot of workers still not being back to work, to be in the situation, I think, of seeing some inflation above target. So, fourth polling question: for prices your business is paying, where are they now? Just give me a general sense. It's interesting. Thank you.
All set, Alex. Thank you.
Thanks, Denise. Okay, so that's a lot of short-term stuff. I think you also have to keep in mind when you're looking at inflation, you have to consider the supply response. We've talked about bottlenecks that are restraining supply at this point. But moving beyond that, in the longer term, what are some things that help to keep a lid on inflation? And I think these are all still longer term things that are at play. And probably if you look at that period after the Great Recession, where we saw below target inflation for such a long period of time, I think you can point to these factors as key drivers of keeping a lid on inflation over the long run. There are really things to do with market forces that have been at play. One is price transparency. So if you think about the internet has allowed price comparison like never before. So that makes it hard for individual businesses to increase prices at such a rate where they're above wherever the market is. At a certain point, consumers can easily check and buy their goods elsewhere. There's also market power that's at play. We've seen longer term national retailers. You can think of big box stores, Home Depot, Walmart, use really aggressive purchasing strategies and global sourcing to keep prices low. So it's another factor which makes it more difficult for businesses to raise prices and try and pass it on to retailers. And so, overall, I think the Fed has some room to respond. I think these larger forces are still at play and will still be at play after we get through these more, I think, short-term difficulties that we're facing. So overall, I think many economic indicators point to gaining strength. We're now, entering in Q2 this expansionary period after a recovery, which is better than I think most of us would have predicted a few months ago. I think the jobs outlook and labor force participation is one of the real key issues that that's at play here, and again we'll have a better sense in the fall of how much of that issue is solved by schools reopening, childcare, and people feeling more comfortable about returning to work. But again, the Delta variant may scramble some of that. But nevertheless, I think in the early fall, we'll have a better sense of where labor force participation is really going. We've talked about producer prices, gross and net's high, reflecting supply constraints. At the same time, you have industrial production ramping up as well in response. It's just that these logistical concerns, supply bottlenecks are major impediments to that. I think inflation is going to continue to attract attention, but if you look at inflation expectations overall in the market, they're not overly concerning at this point, and pretty on track with the Fed's overall 2% target. So I think at this point, if you take into account all the data we're seeing, we're still at the point where these high prices and inflation measures we're seeing are transitory. And there's some expectation that will fall within the 2.1% range in 2021. And with that, let me see if there are any questions. Feel free to pop them in the chat box. And I'll stop sharing so we can see everybody. Absolutely, I can be happy to share slides. Okay, just one moment here. Yeah, impact to labor participation from baby boomer generation retiring or retiring early post-pandemic. I don't have those figures off the top of my head, but it is a sizable chunk. If you look at people dropping out of the labor force, you saw a significant reduction for women and for people who would be in that early retirement age category, 55 plus. So it is a significant factor, and I think one of the I've talked to some economists who study labor force participation and those types of questions, and they were pointing out to me that overall labor force participation, may just be lower, coming out of this pandemic, and it's a point of concern, because if you look at overall economic growth, it's really a combination of two factors: growth in the labor force and growth in the productivity of those workers. And so the fact that we're having fewer babies, immigration's pretty low, and they're probably, I don't know, I'm not a prognosticator politically, but it seems to be a difficult issue in terms of immigration issues. So on the labor supply side, there may just be continued pressure there. So I think what that means is that businesses will be, more and more looking at ways to automate production, which we've been hearing from many businesses. How are gig workers reflected in the labor force participation rate? Good question. They are, I believe, treated as part of the employed, but the way that the question is worded, I believe, yeah, they should be counted as every other employed. So the only difference may be people who, gig workers who are in between contracts may answer the response. When it comes to the question, they may say, yeah, I'm not employed now. But in which case they would probably still call themselves unemployed, and they would still be, counted as part of that labor force participation figure. So there are ways to drill down on that, but overall, I believe they're counted the same as every other employee. Housing prices, will they cool off in the future? Great question. The housing market, as you know, has been crazy. There are so many different factors that have played into that, though. And some of them were at work prior to the pandemic, and I think are just going to continue. Let's kind of tick through them. So regulations over local land use is something you hear a lot about in this area. That's contributed to a restriction of supply of land available to do developments. So that's going to continue to exert upward pressure on prices. Shortage of skilled workers, that's going to continue. Some things, price of lumber, that's happened more recently, is coming back down. There's still elevated other commodities that go into house prices. There's some short-term, I think, response to the pandemic of people moving out of multi-family units, and if they're going to be working from home, they'd rather do it from a larger place. Although I have to say that if you dig down the data about what's been happening with multifamily, you're not seeing as dramatic a drop off in that as some of the news stories would imply. So I think there may have been some temporary move to the suburbs, but I don't foresee that continuing. So in my mind, the stuff that's contributed to the price increases during the pandemic, those are going to come down. But some of these other factors that especially are at play regionally here are still going to exert a lot of upward pressure on housing prices, and I don't see that going away at any point. Yeah, these gig worker questions, I'm going to have to, I have to profess or say I don't I'm not aware of the details. So I have to take a deeper look at that. Lack of new starts. Yeah, I think I touched on that. I really think these commodity issues are going to resolve themselves. I mean, that's one of the things you have to consider with the inflation picture and prices of particular goods and services. You know, increases in the prices are going to entice market activity into those areas, and so there's some correction that will occur with that. And so, in my view, commodity costs and labor shortfalls that we've seen in response to the pandemic are going to go away. But the labor shortfall issue in construction has also been a longstanding concern, and I think we'll, as a country, are still going to see issues with that moving forward. Okay, thanks for that information.
Alex, if there are no questions, I'd like to get you on the calendar again for the fall, because we always find these talks informative, scintillating, and all that jazz. So
thank you so much. I appreciate it. You guys had the best questions.
all right. Well, thank you, and we'll see you in the fall, Alex.
Thanks, everybody.